Okay, perfect. All right. Well, I hope everyone is doing well this evening. So I guess we're going to have an interesting setup for the conversation and Q&A where I guess I talk, but I have to read what folks write. If anyone has questions, you can put your hand up, say it to Alex, and he'll let me know via typing. But in any case, my understanding of the lecture today is that we're talking about how macro is correlated with venture returns and the relation between them. So maybe before we start talking about venture returns, I think it's interesting to also kind of think about venture investing before we think about returns. Because when I think about the macro environment, a big element of the macro environment is what are VCs doing in terms of investing, and how are they assessing whether or not a startup that has been previously funding and is humming along, whether they're ready to get another round of funding, or eventually whether they're ready to have an exit, where an exit can be either an IPO, so that's stuff happening in public markets, or it can be an acquisition. And usually the pricing between those things are at least somewhat related. And so trying to figure out, like, are you on track? How are you doing as a startup? And can you continue to fund your ambitions? And when I think about that, one of the main things that I kind of think about in terms of like macro style, so the style in which stuff is being decided, whether it is worth continuing to invest in, I kind of think, and this is an oversimplification, but it's a good 80-20 on things. I kind of think of two regimes: a regime for funding and for exit that is either focused on top line growth, so revenue growth, or on the bottom line. So are you like heading towards an obvious path to profitability, right? So are you more focused on growing revenue, or are you more focused on getting to profitability? And sometimes when we talk about the macro environment of venture funding, we kind of distinguish between an environment where VCs are far more focused on revenue growth, or on environments where they're far more focused on the path to profitability. So, one question to ask is, okay, well, which one should they do? What should VCs do? Should they focus on revenue growth more, or should they focus on getting to profitability or profitability more? The interesting thing with that is that it actually kind of depends, right? So there isn't like a one size fits all answer. And in particular, I'll try to highlight this with an example. And the example I'm going to highlight comes from the world of recurring revenue businesses that require a lot of costs upfront to acquire a customer, right? So what's a recurring revenue business? It's you acquire a customer today, that customer is going to give you profits every period or periodically in the future. And if you have to pay a lot to get the consumer, think about the cash flows of that customer. Well, the cash flow at the individual customer level is negative today. Maybe you have to pay in sales and marketing costs $100 to get the customer today. But then the customer stays with you for a long time and they give you $10 of profits every period in the future. Now, the question is getting that customer good? If getting that customer is good, then you should try to get as many customers as possible. If getting that customer is bad, then you should not get the customer. Now, if we make the simple assumption that you'll get $10 every year from that person in profits going forward, then actually we know the benefits are like what we in nerdy finance language call a perpetuity. We know that perpetuity formula is P over R. So if you're getting a profit of 10 per period, it's 10 divided by R. Well, if R is 10%, then that's worth $100. So if R is less than 10%, the goodies of the customer are worth more than 100. If you have to pay 100 for the customer today, that's still good. It's a positive NPV customer. If the discount rate is greater than 10%, it's less than 100. And Actually, getting a customer is bad because you pay 100 up front and you don't recuperate 100 in present value down the road. What's interesting about the example I just gave is if you acquire customers super quickly, but the customers are profitable. So let's say the discount rate is 5%, then actually the value of the customer after you acquire them is 10 divided by 5%, i.e. 200, which is way bigger than minus 100 that you pay up front. So every customer you get adds $100 of value to the company. However, you're losing $100 the moment you get them, and you only recover the goodies slowly. So what happens with a business like this? This business should keep growing. It is a good business. Every customer you get is worth positive $100 on the net. But actually the cash flows of that company, if it's growing super fast, are actually going to be negative. And as it grows faster and faster, the cash flows are going to become more negative. If we think of cash flows as being profitability, then what you have is a company that's profitability is getting worse, but it's actually a good company. So if you're focused on getting to profitability with a company like this, you're making a bad decision, because actually it shouldn't be getting to profitability anytime soon. It should be growing as fast as it can, because eventually those goodies are going to start getting cashed in all at the same time, and everything will be very sweet. You do the math, you can find it. So I just highlighted a situation where a company can have profits that are getting worse and worse, but that's actually good news. And that good news is reflected in revenue growth. So that's an example of a setting where you want to focus on revenue growth, the top line, and you don't care as much about the bottom line. But the flip side is, if this is a company where you lose 100 up front, but you recuperate in the future, but that recuperation is not worth 100, it's worth maybe $50. In that case, you want to focus on profitability. So my point being is it's not obvious. Yes, I see a hand up by Alex. I'm guessing Alex
Jiro, can you hear me? I'm going to try to switch
okay, let's
for
try.
the question.
I think that'll be better.
Asking phase.
Sure.
I can't hear you though. So I think what Jiro just described is a very rational, academic, theoretical model of how you should evaluate the growth profitability equation, which makes a ton of sense. And I think it's a model that most founders use to evaluate whether they should add capital and pour more fuel on the fire, or basically whether they have a fundamentally good business or not. I guess the question I would ask for you, Jiro, to elaborate on, and sort of what we talked about in class today, is you're making the decision to focus on growth or profitability solely based on the fundamentals of your business, without taking into account what the capital availability for your business is. So what if you use your former case? Hopefully most startups are in that case, where fundamentally the business is a good business. They acquire profitable customers, but pushing on growth requires them to need to raise more capital that may result in either difficulty doing so in this macroeconomic condition, or really high dilution in doing so because of the valuation that you have to raise at. So how do you balance pushing the lever on growth with capital availability in a difficult market? And just pause for 20 seconds while I switch the audio back to the other computer.
Just let me know when I can start going by maybe putting a thumbs up or putting the hand down. Actually, that might be the way to do it. Okay, so I'm assuming everyone can hear me right now. Okay, that's a great question, right? Look, in some sense, what I just described actually is not what I necessarily think happens in the real world. You're right, it's academic. And I would say the smartest players on both the startup side and the investment side try to do that in good faith. But I don't think every player tries to do that. And there's a bunch of other wrinkles. And so here's part of the problem is, I think exactly like Alex said, now let's think of a world where you're the startup founder and you do exactly what I just described. You're a smart founder, you do it. Can you run into problems? The answer is yes. Actually, you can run into problems, because you can run into problems exactly as Alex said. Well, what if funding dries up? Because in order to keep on growing the way I described it, you're going to be losing more and more money on the short run, meaning you need to raise more and more money in the short run. Well, what happens if actually the money dries up, right? And actually, I think one of the reasons the money dries up is that investors start to get worried because they actually think to themselves, oh, actually, you know what? Other investors are only going to focus on profitability now. And so because other investors, either investors in the stock market or other VCs, because they're going to focus on profitability, they won't want to fund this company anymore. Since they're not willing to fund this company, I, the VC, am not able to fund it myself. So I'm not even going to be able to solve the problem. And so because of that, I'm going to stop funding them too. And so now all of a sudden, the funding is going to just all dry up. By the way, it might not even just be the stock market and other VCs. It'll also be the limited partners of my venture fund. If my limited partners, the people who give me the money, that as a general partner of a venture fund, I invest in the startup, if I'm worried that they're going to be like, Jiro is crazy, he's been throwing good money after bad, they're not going to give me any more money. And I'm going to be like, oh, damn, right? So all of these things kind of highlight something, which is that like beautiful academic treatment that I just mentioned that is so clean theoretically. By the way, easier said than done in the real world. That's another complication. But, that would make everything work well and would get all these great companies with value props that are positive and, just happen to lose money for a long time, but kind of grow their way out of it and become hugely profitable down the road. Like, in order for that to work, you need to have faith that capital will do exactly the right thing as well. And the problem with that is that there's so many challenges there. One nerdy academic way to talk about it is a coordination problem. In fact, what I described in words a second ago is exactly that, a coordination problem. I only want to be the smart VC if I think every other VC, every other limited partner, every player in exit markets, i.e. corporations and investors in the stock market, let's say, only if all those folks are smart. If I'm worried that people have like shifted loco now or not smart or whatever you want to call it, now all of a sudden I don't want to be smart anymore because actually in that scenario, the smart person loses. And so now capital will dry up. Now, of course, if the startup now recognizes that capital will dry up, they're saying to themselves, damn, I've got all these opportunities to purchase valuable customers. But if I do this, I'm launching myself off of a cliff. So now they're not going to want to purchase those customers either. They're going to slow down growth in a way that's not efficient. And so when you have these shifts in the macro environment, like we've seen recently, there's a big risk that that stuff happens, right? Which is a pity, Well, I don't really know how else to put it. It's an inefficiency. And I think it's a very interesting one. Yes, Alex.
Can you hear me?
Yep.
So what you described interestingly is that you called it a coordination problem, and what I took away from it was this like idea of a herd mentality sort of in venture, where and there's some rationality to it because I need somebody to finance my deals eventually. So I sort of need to care about what the other VCs think because in a way they're going to be the ones that do the next round and so on. We listened in class today to a podcast with Mike Maples Jr. from Floodgate, a very famous VC. And he basically said that basically that herd mentality is the opposite of the power law, which is all about making non-consensus decisions and how you only make money in venture when you go against the herd. And I guess my question to get your thoughts on that would be like, how do you balance this idea of understanding what the herd's doing such that you're sort of aligning yourself right from a macro standpoint, but also being non-consensus in the way you deploy and allocate capital?
Just put the hand down when you can hear me. Perfect. So yeah, that's actually a very interesting nuanced question. I'll give a speculative answer because I don't know 100% for sure, but like at all. But yeah, I mean that is interesting, right? Because there's like we have two statements here that just seem at odds, right? Oh, your goal as a VC is to be contrarian and right. That's the holy grail for returns. And yet there's these periods of like herd behavior, right? Now, what I'll say is I think the focus on contrarian and right is much more common in the early stage of VC than in the later stage of VC. And so you might be less worried about the shifts in the herd in the early stage, because early stage investment, it's not as much of a group, it's less of a necessary to be a group activity, because probably if I fund the seed stage and whatever, like the market goes loco between my seed and my series A, I mean, so long as we can find a couple of VCs that are willing to be like a little bit bold at the series A, like the shifting might not happen in the series A. It'll start to happen more in the rounds that are really huge, where you need actually more folks kind of going. And it probably gets worse the closer you get to exiting in public markets, because we usually take it as a given that public markets are more likely to be loco. But okay, that's a controversial statement, but that's one view of the world, right? So maybe that's, and then the other thing is probably when you're contrarian, you almost want to time being contrarian. I want to invest when I'm contrarian, but when I believe that the sentiment is likely to shift pretty soon. So I don't want to be contrarian and right and super duper early. I want to be contrarian and right just before the rest of the crowd shifts to being in my worldview, so that my contrarian shifts into consensus, so that now, cha-ching. See what I'm saying? So there's almost like not just a contrarian element, it's like timing the shift of sentiment, right? So I think there's probably a little bit of that. But if you allow me to back up a little bit, there's one other thing I'd like to talk about. The other thing I'd like to talk about is like we talked about shifts in crowd behavior, of like now you're no longer appreciating the value of a company with attractive customer acquisition that has mega top line growth, but has worsening profits, right? And I said, hey, that stops good things from happening. And that's like an inefficiency. That's not ideal. But there's actually another inefficiency that I feel I saw actually in the market before the tide shifted at the macro level, which is almost like the reverse kind of loco. So instead of like loco pessimistic, it was loco optimistic. Because let's remember the example I said where you've got a company that has recurring revenue. They pay 100 for a customer, but now let's assume that instead of having a value of 200 for the customer afterwards, so that it's net plus 100, instead, let's assume that the net value of the customer after is 50, so that the net value is minus 50. If the market is only focusing on revenue growth, they might think this company is great, whereas every time it's buying a customer, it's destroying $50 of value. You see what I'm saying? If you don't have a nuanced perspective on revenue growth so that it's anchored in good fundamentals, then you might start funding things that are bad because you're not even thinking of the value of a customer, which, by the way, in practitioner parlance, this is called unit economics. So you don't focus on unit economics, or you do it naively because you just want people to keep dancing, loco optimistic, by just like continuing to fund stuff that has good revenue growth. Like I have a great way to grow revenues. If I sell dollar bills for a nickel, I'm going to get a lot of revenue. I just have a shit business, right? But if people only look at my revenue growth, they might continue funding my ridiculous thing. And I feel there was a little bit of that in some segments of the VC market during the, hot funding market as opposed to the cold funding market. And that's not a good thing either. If I can just offer, before I go to your question, Alex, just one clue to this. I'll mention one. I'm not going to give you the name of the company because that would be bad for the consulting stuff that I do. But like, there was a company that had hired me. This is a startup. And actually, it's a pretty prominent startup in Canada. I won't say more than that, but like, they had asked me to do a unit economic analysis for their company because they wanted to show they had good unit economics so that they could justify getting funded even though they were losing more and more money. And then I asked them, okay, happy to do it. I need this data, that data, that data, and that data. And when I asked them for the data, they decided they didn't want to hire me. And my view is actually because they were afraid of the answer. They were afraid that I would look at the data and find that the unit economics were negative and that they should not be growing. And they were like, well, we don't need a silly, nerdy academic person like me to like vouch for it because they can just kind of give a story that makes it seem like there's good unit economics. And they were really good at raising money. They were really good at raising money, right? By the way, I learned something from that. We actually, Alex and I talked about this before, which is that like, if you've got a company that doesn't have technical people who will do the rigorous numbers, but they have really charismatic fundraisers in a hot funding market, I'm going to be a little bit scared as an investor. That's just an opinion driven off of one experiential data point. I could be wrong, but my point here is when you think about, hot versus cold, it's not about efficient versus inefficient. There's probably inefficiencies in both regimes. They're just different, right? One is you fund things that are bad, but that have high revenue growth. That happens in a hot funding market. And in a cold funding market, you may fail to fund some things that have bad profit trajectories, but only because they're growing fast. And it all hinges on unit economics. That's the kind of common thread, which also brings the question of maybe everyone should become better at unit economics analysis. That's something I teach pretty rigorously in my VC course, Finance 447. I teach it because I'm a true believer that making sure everyone in the market is able to do that at least somewhat competently would be actually a good thing. But that's my opinion. Sorry, I just wanted to close the loop on that, Alex. Go ahead.
Yeah, and what you're describing, Jiro, and I guess for the context of the class, is very much the Renault Run story. So, I mean, we were a business that had negative unit economics. So if you think about, I could share a little bit more context about what we did, but basically we would deliver building materials to job sites. So if a contractor needed lumber, drywall, whatever, we would throw it in a truck, we would deliver it to a job site. On average, we would charge something like 5% more than what they would pay at Home Depot. But then we would have to pay for the vehicle. We'd have to pay for the staff. We would bring them coffee. We had a warehouse lease. We had a customer acquisition team that was composed of both sales and marketing. And when you account for all of those costs that I just listed, getting one package to a job site would cost us 30% more than the revenue, we would take in. We had essentially a negative 30% hit to our cash flow for every single order that we did. Meanwhile, we were trying to grow as fast as we could. So what happens is when you do one order of $100, you net a $30 loss. All of a sudden, if I'm in 6 cities doing 1,000 orders a week, doing $1 million of revenue a week, all of a sudden I am burning 300K a week just on delivering orders. Forget about all my overhead, like my management team and my engineers and my everything else. So with every additional order that we did, we would lose more money. Now, for us, we knew that, right? So Jiro's talking about unit economics and people don't know how to calculate them, which I agree with, and that's true. For us, we knew that. It was obvious. We knew that we lost 30% on every single order. But founders try to pursue, and we've talked a lot about the power law, this like promise of the future, right? It's like, I lose 30% today, but just wait. Like, I lose 30% because I only do 1,000 orders a week. Wait until I do 10,000 orders a week. Wait until I do 50,000 orders a week. Wait until I'm as big as Home Depot. And that was the playbook that Uber took, and amongst a number of others, where they could not show a profitable unit economic model. We could not show a profitable unit economic model, but we were capable of raising capital by painting this sort of unicorn future promise of glitter and gold that we couldn't explain rationally with numbers, but that people bought into because they thought it was just attractive to be in the construction market. And that's where there's a bit of a disconnect of reality between selling this future dream that VCs get excited about because of the power law and connecting it down to what it actually means for your business today from you in an economic standpoint. So I don't know if you have reactions, Jiro, to that, but just thought I'd provide some real world context to the story.
Yeah, no, absolutely. Just put the hand down again. Okay, perfect. Yeah, I do. By the way, so there's something that I didn't talk about so far that Alex actually very nicely points to, which is actually there are some settings where your unit economics right now are not good, but there's a real reason to believe that they will become better in the future, right? And if that's the case, then things might look bad now, but they'll get better later. By the way, Alex, I would say that you should you should make an attempt to model that in the unit economics. Oh, my capital utilization will get better. I actually think you guys modeled that, if I recall. But then the other thing is, one of the big things with a play like Reno Run was actually the reason why we'll be able to make positive profits in the future is actually because by building a loyal customer base and density within a city, we're going to get some sort of barrier to competition in the long run. Maybe it's a network effect. Maybe it's a marketplace effect. Maybe it's just a brand value that will allow us. So what we want to do right now is we want to build, let's say, that network effect. We want to build it. And once we build it, we'll be able to charge for it. And so we're willing to lose money right now to incentivize people to join the network. And once once enough folks have joined the network, we don't need to give as many of those goodies. We can raise the pricing a little bit more, and we will find a way to make it profitable, right? So there are some businesses where there's a potential path to that kind of thing, where you want to subsidize customer acquisition early on to build something like a network effect or a marketplace effect down the road. If you want to have a great example of a company that did that, and at least had a good exit for their investors, whether they're great in the long run is a separate issue, or whether you like them is a separate issue, but is Uber. Uber subsidized building their network, especially on the driver side, but also partially on the rider side, for years. They literally raised 18 rounds of funding. I don't even know how many billions of dollars they raised. They had cash flows that kept getting more and more negative. It was in the name of a marketplace effect, a two-sided marketplace. Once they built it, everyone would use them, or a lot of people would use them. I mean, I don't remember the last time I used a real cab. So there are settings where you can justify unit economics looking bad right now, in particular as proxied by your transaction by transaction gross margin right now, where you say, like, look, the gross margin will get better because once we are the destination for this, we will A, monetize that better, and B, we'll find other ways to do extra monetization. I mean, look at Amazon. Amazon did this too. God, like Amazon, like in their first 8 years, turned profit 1 year, and then they quickly went back to not turning a profit. I think now they turn a profit, right? But like, that's like whatever, like that's like 25 years later, 30 years later. I don't even know. And think about what Amazon has done. They now better monetize the main thing they did before. They productized other cat verticals that are higher margin. They also created a third-party marketplace that they can monetize much better because they just take a cut of the revenue, right? So they found ways to take their network, their marketplace, and really monetize it to the max in so many different ways. So, part of what I'd say in terms of what Alex said is, like, he's right. I mean, if you proxy unit economics by transaction gross margin today, then that can be misleading about the future of transactions. And Also, the future of transactions from this person that you delivered a screwdriver, a cup of coffee, and Band-Aids for $4.50. I don't know. Yeah, that's kind of shitty today. But like, if later on you get to charge $10 for that, and they're buying some plywood, and right, there might, it might start getting positive down the road, even though the transaction today is not positive. A lot of times when people do unit economics, they assume that the profitability of the transaction is super static. That's not actually true for certain types of businesses. Network effects businesses, marketplace effects businesses. If you build a good network, you'll be able to monetize it. You may very well be able to monetize it down the road. Sorry, you have your hand up. Sorry, I was kind of into this, so I didn't see that.
Yeah, so you made an interesting point, Jiro, which is, you want to pitch that these things are improving, which is what I was saying. We would pitch the dream. And when we went out and raised $120 million for a Series B, we did exactly that, right? We put all that stuff in the unit economics. Look at what happens when we build the marketplace. Look at what happens when we get to scale. As soon as we went out and raised the Series C with the same things in the model in 2022, all of a sudden, all those things were bullshit, right? So back to the macro, it was really easy to convince somebody in 2021 that if you build that marketplace, it will accrue, positive unit economics at scale. It was impossible to convince people of that in 2022. And I remember one VC, when we were talking about utilization, I was like, look, my warehouse is at 40% utilization. Like, obviously, if I use more of my warehouse, my economics get better. And I remember the VC looked at me and he's like, Alex, that's a bull market metric. He's like, all I give a shit about are what's in the financials today. So all of a sudden you see a macroeconomic change and there's no imagination about what the future might look like anymore. There's no imagination about how that marketplace may take shape and what those network effects may look like. All of a sudden they care heavily about what you've achieved in the past that dictate what profitability might look like today versus what you might achieve in the future. And it makes me reflect on, okay, if Uber had been founded in 2017 instead of in 2010 or 2009, would they have faced the same challenge, right? Would they have been able to raise $20 billion of capital with that model? Would they have been able to keep putting fuel on the fire, or would they have faced a similar death? So that's just sort of tying together that. Do you have comments on that, Jiro, or do you want to move to another topic?
So just yeah, okay, perfect. I mean, look, in some sense, what Alex just described was that in the bull market or in the hot funding market, that's the lingo that I like to use, like, people were loco optimistic. They were willing to believe a story of improving unit economics because they are like, okay, well, it's either they think it's believable or they think, well, actually the next people who give money or the people who are going to buy the shares at exit are just going to care about revenue growth. So I just want to dance. Everyone dances. A little bit crazy. That's what I meant, actually, was about the bad side of this kind of stuff, right? But by the way, like, it's, you might actually misinterpret what I'm saying. You might be like, oh, Jiro's saying, like, if everyone just did unit economics perfectly, everything would be great. And because people don't do it, you've got loco optimistic in a hot funding market. You've got loco pessimistic in a cold funding market. Like, just, the solution is easy. Take Jiro's VC's class. Fuck no, right? Because it's really difficult to do unit economics well. Let's think about the example that that Alex brings up, which is, or that we talked about a second ago, which is, there's a network effect. And if the network effect is successfully built, you'll be able to make more money in the future. Okay, fine. I can kind of get the logic of it all. I get it. I have no clue how to mathematically model that, because I actually need to know the relationship between my ability to charge a margin and the size of the network. And I need to make a forecast on the growth rate of the size of the network. Oh yeah, good luck with that. I don't know how to do that. So I'm very happy to talk about a theoretical story. If you actually hire me to try to do unit economics for a marketplace business, or like one of these network effects businesses where it's actually justifiable to like actually lose a shit ton of money in the early on because you think you can recover it in the future, I'm probably actually not going to do it. The reason I'm not going to do it is I actually have no quantitative guidance that really helps me do the math correctly. So I actually generally only do it in settings where like the ability to make improvements down the road are things that I actually think I can model. So if you've got something that's based on proprietary data, then I can actually kind of give mathematical predictions of as you have more customers, you will have more data and it'll improve your analytics. And because of your improved analytics, you'll be able to charge, you know, this much more for your analytics-based product. Like that, there's actually like stuff, like really nerdy stuff in statistics and probability theory where you can actually kind of measure as the data grows, what is the value of the information? And if you're doing the analytics well, you can put a price on it. So like there's some settings where I can do it. Most of them I can. eBay, I cannot. Uber, I cannot. I don't know how to do that. It's not a quantitative thing. It's this. And so it boils down to storytelling. And like, God knows, I can maybe help you tell a story, but is it going to be quantitatively positive unit economics or negative unit economics? I honestly won't know. Go ahead.
Okay, maybe we'll do one last question and then break.
Sure.
I was reading an interesting article by Chamath, who is a famous VC from Social Capital, also happens to be Canadian. And his argument was that better companies are built in down markets. And the argument goes something like, in a bull market, when there's tons of capital and there's tons of companies, resources end up sort of being evenly distributed amongst all of them. And so you have capital basically deployed everywhere, talent deployed everywhere, everybody chasing money. And what happens when you constrain resources and all of a sudden VCs get more selective about what deals they underwrite, all of a sudden talent gets more selective about what companies they join, you actually see more dense pockets of attractive resources end up in a select few companies rather than all across the market. Curious to get your thoughts and reactions on that, Jiro.
Yeah, if you can hear me, sorry. Yeah. My thought and reaction is rather simple on this one. I agree. I think that's right. It's one of the reasons why I'm paying more attention right now than I was, 2 years ago, actually. I was always scared 2 years ago. Now I'm like, interesting, maybe. I'd also say that like, because resources concentrate in the product and service market, in terms of the startup, they'll actually probably be able to go longer before like competition and copycats come in as well. Right. So there's like, I think like many wrinkles where like during a bear market, at least the winners may very well be ultra winners. And I think that's kind of consistent with what we've seen, at least with the modern history of technology startups, right? Like, many of the biggest home runs were like after shit hits the fan, right? So, Google is in the aftermath of the dot-com bubble bursting. Uber is in the aftermath of the financial crisis, right? Facebook was timed kind of a little bit in between, so it doesn't fit that narrative so well. But, something that's interesting with Facebook is they became profitable super early. So they were actually quite different. They somehow got traction so fast that they were able to monetize. So maybe they had less concern around it. And I guess, social media was a reasonably big market. Anyway, they weren't the first player actually, right? Like, there were some other company, Friendster and MySpace, but they actually, both of those screwed up in like important ways. But anyway, the short answer is I agree.
All right, well, it is 8:45, so maybe we'll leave it here. Jiro, I'll hand it back to you in a second, but you'll post this, I guess.
Yep.
Any final words for the class?
I hope everyone had a good evening. Even though I can't see any of them except you, Alex, but yeah, look, it'll probably not be the last time where there are unexpected things that happen. We will fix the whole thing of a non-operating Zoom classroom. So we will make sure that at least for an external Zoom speaker, by the next one, that this classroom is set up to like just work. It is a bit of a surprise that it's not pre-set up that way, but it is what it is. And there'll be sessions with people in person, and yeah, I mean, whatever. At least I hope you guys enjoyed this evening, and I'm sure Alex's session was wonderful, and I hope everyone has a good night.